With the rapid societal changes we are witnessing, what are the latest innovations in the field of financial management?
I would not restrict to financial management, to financial economics, really, because, you know, until the 50s, finance did not exist as a field of knowledge, an area of knowledge. It is basically a mark of its results in the 50s about efficient frontier and decision under uncertainty. And the Modigliani Miller in the early 60s that created the field that we know as finance today. And that field, if you put things together, corporate finance and financial markets, is about studying and characterizing the trade-off between expected return and risk. There are two key things in this. It's expected return, how to build expectations, and risk. How do you identify risk, characterize, measure, and finally manage risk? So the trade-off between these two things is the essence of the field of management. Financial management or financial economics, if you wish. So the source of this knowledge comes from economics. The application of this knowledge goes into management. That's why finance is sort of like strategy, a hybrid area. Nowadays, currently, you see a lot of challenges in the new risks that our society poses. Very easy examples of that are, you know, the climate changes challenges, the sustainability challenges, the new technology, artificial intelligence challenges, and that kind of thing brings new perceptions of risk and also new ways of building up expectations. So this is why the field of financial economics and financial management have to evolve in order to adapt to these kind of changes in society.
How significant is climate change in shaping the frameworks of financial economics?
Well, that is a very good example because it's change. So climate change is a radical form of change that our society is passing through. And it's very radical. It started in the Industrial Revolution, but it took a peak on the carbon dioxide emissions and actually levels in our atmosphere that changed completely the climate. That actually affects a lot of factors of production factors in agriculture and in many other fields, and that actually puts at risk the kind of products that we are used to consume. Also the fact that our population is growing tremendously, that technology is bringing in new forms of productivity. We actually have to produce enough food to feed, you know, like 7 billion people nowadays in the world. And that is tremendous compared to what we used to do a couple of decades ago. So we accelerate production with technological levels. We increase the emission and the levels of carbon dioxide. We change the climate that in a different way affects the way we produce. So the fact that we produce is implicitly having feedback effects. And we have a tremendous difficulty, actually, in assessing the risks that are associated to the production. So one of the things that climate finance is very important is actually to bring it to the table, the discussion of how we now identify the new risks, how we actually measure the new risks of this complex new situation, and finally to manage. Insurance companies are a very good example. They cannot insure anymore in the traditional way the risk of wildfires, the risk of storms, the risk of floods. Actually, in the United States, there are billions and billions of dollars that are spent by governments, and that's taxpayers' money, into covering the costs that insurance companies are no longer able to cover because they don't have means and ways to assess the risk of these events. So this is clearly a radical situation where the field of finance, which is the area that understands and tries to describe the trade-off between, again, expected return and risk, is critical. That's why climate change is so important to be discussed in the classroom, and that people should be more and more aware of the reality of these risks and how to measure them.
Given the impact of technology, should cryptocurrency be considered a significant topic in the educational curricula?
I find that all the technological advances that affect the financial markets, it's not finance per se, but it's actually how financial instruments and financial markets react given technological advances. So it's not only in the way we produce food and everything, but it's in the way we actually develop services. And that has to be included. Blockchain is certainly a very important tool that is affecting a lot of markets. Cryptocurrency is a particular case. Because it's a particular case, because it's a kind of investment, and people tend to think that it's an investment like, for instance, the stock exchange. It's risky because it may go up, it may go down. But the main difference about the cryptocurrency is that when I look at the stock exchange, I know I can make a rationale why stock go up or down. I can understand that the factors of production in that particular sector, in that particular industry, were at risk because of some natural accident, because of COVID, because of, I can't really understand what drives the supply and demand for a certain good that implies the going up or down of a stock price. That is when we deal with assets whose value are grounded in economic foundations, right? The problem with cryptocurrency is that it goes up and down without any economic fundamental. It's about speculation. It's about aggregate demand that actually makes the value of the currency, the cryptocurrency, going up or down, but I don't have any economics to explain why this thing happened. So it is very risky because a lot of people become very enthusiastic because it's like a pyramid scheme where a lot of people get engaged in this kind of investment and they make a lot of money. So they think until the market drops. So everybody, when they make a lot of money, they are hysterical, they are very happy, they share that with us. But when they lose money, we don't hear about it, right? It's like they are ashamed of losing money because they don't really understand why they lost the money. So I think that coming back to what finance is about, the problem with cryptocurrency is that you cannot really assess the nature and the source, the economic nature and the economic source of the riskiness that this kind of asset is actually based upon. So I think that, yes, technology has a lot of interesting sides to be discussed. That's perfectly okay. But cryptocurrency is one of these examples that it's interesting to discuss as a counterexample of what finance theory can help you with.